Hi YouTube, this is Frugal Millennial and welcome to this episode of Finance Fridays. Today, I'm going to talk about interest rate. Are fixed interest rate going to go down any further or will it rise sooner than expected? And what is Australia going to do with housing affordability? There's a lot to talk about, so please stay until the end. Before I start, I should let you know that I'm not a financial advisor. The information in this video is for general information purposes only. I highly recommend you seek financial advice from a professional to double check the information I have provided here is correct. Fixed mortgage rates are dirt cheap at the moment. This has contributed to the fact that RBA has made several cuts to our interest rate last year when recession hit our shores and household wealth decreased. As the interest rate dropped to 0.1%, people felt that money was useless just sitting around in the bank, and they decided to spend it, thereby stimulating the economy. First homeowners saw this was a perfect opportunity, and they took advantage of the low interest rate and other fiscal support. This led to an unprecedented amount of first home owners getting pre-approvals for home loans. Furthermore, housing stock in March was 25% below the 5-year average. The combination of drastic increase in demand and lack of supplies have driven up the house prices. In the last few months, we saw strong growth of house price in regional areas, spurred by the change of migration from capital cities. However, for the first time since the pandemic started, the growth in our capital cities have overtaken regional areas. You can see here the increase in house price for last month for capital cities around Australia. And there seems to be no slowing down, with the house price rising the fastest in 32 years. The question then comes, have we reached the bottom of the interest rate decreases? And when will the interest rate increase? And is it a good time to fix my rates? Most fixed mortgages are currently cheaper than their discounted variable rates. Latest data show 50% of homeowners are fixing their mortgages to take advantage of the low interest rates, compared to the traditional 15%. What are the chances of a rate decrease? There's a school of thought that rates will go down further, as our rates are not the lowest in the world. When we compare our rates on a global scale, many European countries and Japan have lower interest rates than ours. Some experts believe there's still room for the drop of fixed rates for shorter lending periods because the competition between the banks is very fierce. Increasing rates, on the other hand, is more likely. With the property market on an upward trend, there's also a lot of pressure on RBA to increase rates. A recent Bloomberg report stated that there is 30% chance of the RBA being forced to hike interest rates by the middle of next year. Around the world, the borrowing costs, as indicated by government bond yields, are rising. This has consequently put pressure on the RBA. To also raise rates. In addition, Australia is on an accelerated rate to economic recovery. Recent data show that unemployment and underemployment has dropped quicker than experts first predicted and is at a pre-pandemic level. The strong employment growth this month saw employment rise above 13 million people and was 4,000 people higher than March 2020, said Bjorn Jarvis, head of labour statistics at ABS. CBA has dropped its end of 2021 Australian unemployment rate forecast from 5.5 to 5%. The quick recovery has made people speculate that there could be an interest rate rise sooner than later. Some banks are already lifting their 4 to 5 year fixed rates in tune with RBA's prediction that the inflation will reach 2 to 3% mark around 2024, and hence the rates will need to be increased to compensate for the decrease in buying power. Philip Lowe, RBA's governor, said the board will not increase the cash rate until actual inflation is sustainably within the 2 to 3% range target. For this to occur, wage growth will have to be materially higher than it is currently. This will require a significant gain in employment and a return to a tight labour market. The The board does not expect these conditions to be met until 2024 at the earliest. Furthermore, experts also believe that banks might even target the 3-year fixed rate by the end of this year. So, it is more likely that the interest rate will increase, but it is not going to be any time soon. So the low rates are here to stay for now. As mentioned just before, that Australia's economy has had a rapid recovery in the last year, with unemployment and underemployment rates dropping to pre-pandemic levels. Furthermore, our wages have not grown significantly, which is why Dr. Lowe is still very supportive of his stance that rates will not increase until 2024. Dr. Lowe is also adamant that RBA will not increase the rates to help with housing affordability, because keeping rates low is a known strategy to encourage economic recovery, decrease unemployment, and tighten our labour market. Put it simply, his job isn't to make housing more affordable, but to steer the economy into recovery. Recently, in response to housing affordability, he stated that there are various tools other than higher interest rates to address the concerns. Before we talk about policy changes, please use my link for stake.com.au where you can buy US stocks. If you use that link, you can get up to $150 worth of stock for free. Also, if you want $10 worth of Bitcoin through CoinSpot, use my link below. They have one of the most secure crypto platforms around. Now let's talk about potential various tools that Dr. Lowe is talking about to slow down housing affordability. The most likely thing is a regulatory intervention from the Australian Prudential Regulation Authority, or APRA, which is our banking regulator. They can step in to limit lending. In addition, some economists even believe these regulations will be introduced this year, as there is a decrease in lending standard by banks. The chief economist at AMP Capital even said, past experience indicate that the surging house prices lead to a deterioration in lending standards and increased financial stability risks. This includes giving out riskier loans such as loans with high loan-to-value ratio and increase in interest-only loans. If the lending standards are tightened, it will make loans harder to get approved, therefore decrease the amount of property hunters on the market. However, from the graphs of the amount of interest rate only loans and the number of higher LVR loans, we have not seen significant increase of either loan types. Therefore, our lending standards seem to be relatively intact. Another way to slow the acceleration down without decreasing the interest rate is to increase supply, which again has nothing to do with the interest rate, but might help the issue of housing affordability. We have already seen our New Zealand neighbours take more drastic measures to combat their housing affordability issues, as their residential properties increased by a whopping 16.1% in the last year compared to our annual 6.2% increase. Some areas such as Central North Island went up by 41.5% alone. The regulations include removal of tax deductibility for interest on loans for investment properties, extended to the period to which the property sale attracts a capital gains tax from 5 to 10 years. Favouring new builds in these tax changes, introduce rules that make family homes liable to capital gains tax if sold within 10 years and rented out for more than 1 year, and raise income and house price caps for first home grant scheme. Although right now it's too early to tell whether any of these policies will boost supply and ease the affordability, there is already talk that Australia could easily follow suit. But that's just that. It's only talk for now. Furthermore, once our borders open and immigration is allowed again, there could also be an influx of international investors into Australia, further driving up property market. Only time will tell. So if you're thinking about acting quickly to buy now and lock in the current fixed rates before any potential rate hikes or potential policy changes, you might just want to weigh the risks. Fixed rate sometimes means you don't get an offset account, which is an account that makes it easy for you to withdraw your money out of your loan, almost like a regular everyday account. There might also be a cap on how many additional payments you can make per year, and there might be costly fees involved in exiting the loan agreement. Sorry if this video is a bit delayed, just been feeling a bit under the weather, just waiting for some test results to come back from the doctor. So taking it easy this week. I was gonna do a suburb profile on the We Love Wednesday video, but it will have to be next week. FYI, 2 people are interested in an area in Hobart, so I'm gonna do a profile on that. I also have lots of requests on how to start a website, use Google Ads, and run a business. That'll be in my future videos. I know a lot of you have been messaging me on Facebook and Instagram. I just haven't had the chance to read and reply to all of the messages. But if you could in future, message me below and I'll answer the questions, and anyone that can see your question can also contribute or learn from it. So it's a win-win for everyone. If you want me to bring more content like this, please like and subscribe and share this video. Until next time, thanks for watching.